Hi, this is Ankur. In this video, we'll discuss about what are mutual funds and how do we use mutual funds for our asset allocation. Well, first of all, mutual funds or a bouquet of mutual funds is good enough for a majority of people to grow their wealth. That is why understanding mutual funds is really critical, and it should not be treated as it's a very simple investment and I'd want complicated investment for my growth of assets. Well, frankly speaking, it's a simple way, and let's understand why it is simple and how you can use mutual funds for your growth in wealth. So, first of all, what is a mutual fund? Well, a mutual fund is basically a pool of funds with a certain objective. It varies across what kind of mutual fund you're referring to. For example, equity has an objective to allocate in a certain category of equities. It could be a large cap, mid cap, small cap, or across all capitalization. That is, irrespective of the size of the company, the investment happens. So, that is the first category of mutual fund. The second is debt category. On its own, you may feel that a debt category is simple, instead of fixed deposit, you invest here. But even within debt, it can vary across what kind of objective it is. For all practical reason, what I believe is mutual funds in short-term categories should be used when it comes to debt. Any form of medium or long-term category of debt, which is where the bonds investment is for a longer duration, are riskier, especially in this rising interest rate environment. There is a chance of capital depletion if you invest in medium duration bonds or long duration bonds. So ideally, the asset allocation should be allocated more on liquid or short-term debt category. The fluctuations would be very, very limited. And the third category is gold. Well, you can invest through mutual funds in gold. The underlying would be a gold exchange traded fund, which is 99.99% purity. Obviously, this is a digital gold we are referring, so there are no making charges or anything of that nature. So we see that across three categories, we can do asset allocation when we combine different categories of mutual funds. One of the important categories, which is real estate, is not there. So you can't get exposure in real estate through mutual funds, at least so far in India. Now we move to the expense. Well, it varies across mutual funds. In case of equity funds, it would vary between 1 to 2.5%. In case of a debt fund, it would vary from 0.1% to 1.5%. Anything which is more complex in terms of strategy will command more expense ratio. For example, a credit risk fund in case of a debt category would be at a higher expense ratio, whereas a liquid fund would be at a lower end of the expense ratio. Now we move to one of the important aspect of difference between direct and regular mutual funds. Well, any fund which is launched in the market will have a category of either direct or regular mutual fund. What does a direct means? Which basically means directly you're dealing with the asset management company, and it will have a lower expense ratio because there are no brokerages that are paid by the asset management company, also called AMC. And in case it is a regular stands for brokerage product. So you're dealing with a distributor. It could be a bank or a local agent, but there is a brokerage fee that is paid to the distributor by the asset management company, and hence there would be a higher expense ratio. Oftentimes there is a debate, irrespective, people should go with the direct category. Well, ideally speaking, yes, but think about it. Doing your own research and figuring out which fund is suitable is a tricky task, and you may be stuck with bad assets, and that will eat away your returns. It is better to be associated with someone who can guide you. Ideally speaking, an advisor, because an advisor would only deal with direct category. But even if you're associated with a distributor and if you think you're getting the right advice, there is no harm. There are a lot of videos that float around claiming that direct is better than regular. I have a view that unless and until your income levels or the asset portfolios of a certain kind, do not expect high quality advisory from a lot of players in the market. So sticking to distribution might be suitable. However, being blind even when you're dealing with someone may also not be a good idea. So you have to keep your eyes open, and educating yourself will always help. So whether it is a direct or a regular, self-education is the key when it comes to your investment growth. So now we move to where can mutual funds be used in terms of how we can use the mutual funds, in what category mutual funds are suitable and in which category they are not suitable. So first is the equity. We start with the large cap. These are large companies. Whether a large cap mutual fund is suitable or not. Historically speaking, in India and abroad, a lot of large cap companies in the form of index have been able to beat the mutual fund performance. So it might be wise for you to not invest in a mutual fund when it comes to a large cap category. What is suitable is probably an exchange traded fund covering the large cap. The chances are that large cap exchange traded fund would beat the performance. Exchange traded fund is nothing but an index fund. So you're buying the index rather than a selected set of companies within that index. That's what mutual fund does. So within large cap, probably you can pass mutual funds and stick with ETFs there. The second category is mid cap, rather I would say mid and small cap. Companies beyond top 100 would be categorized as mid and small, and there would be around 400 odd companies. There is a lot of return generation that happens in this category. So far, mutual funds have been able to add a lot of value, but the performance varies from one fund to the other. So a reasonable level of understanding is required when you're investing in mid or small cap. If someone picks up a large cap mutual fund, the chances of destroying wealth would be minimal, even if it is a bad fund. But the chances are very high if you pick a mid or a small cap fund that the performance may be poor and drastically poor in comparison with the best performer. So sticking with a fund house, a fund manager that has a long-term vision, at least 5 years and beyond, will have a better payoff when it comes to mid-small cap category. Other than this, I've just categorized as others because recently, few years back, SEBI has mandated a lot of combination of mutual funds, which is great from a layman perspective, but at the end, I would categorize as others. For example, there would be a fund irrespective of the category they are investing. So these are multi-cap fund or flexi-cap fund. There would be funds with a particular theme, say just in banking, just in energy, just in technology, and so on. So those are categorized as others category. In that also, underlying is the key thing, how the fund manager is picking up stocks and what kind of strategy they have, the focus they have. Are they trading too much, which is the turnover is really high, or with a focus of at least 5 years quality companies? So these are the nuances that an investor has to self-educate in terms of how to understand a fund manager is doing a reasonable job or not. Now we move to debt category. Within that category, as I mentioned earlier, there is short duration, medium term, and long duration. Along with debt, I would also categorize arbitrage fund, although they are taxation point of view treated like equity, but they are very well like debt funds. They generate around 5% kind of return. So arbitrage funds are fine to look at. Liquid funds are fine. Ultra short term debt funds are fine, and short term debt funds are fine. If you look at medium term or long term debt funds, it can backfire, especially when it is a rising interest rate scenario. How do we do asset allocation with respect to mutual funds? Well, one of the simple things that I'm inspired by Benjamin Graham is you start with a combination of 50% debt and 50% equities. So this is the base case. Now, depending upon the kind of person you are, you could be a very conservative person. In that case, you can have, say, 75% debt and only 25% equity. And similarly, you could be aggressive. So you could be 25% debt and 75% into equities. But this is how you structure. Obviously, within equity, you will have some allocation. Within debt, you will have some allocation, depending upon the kind of person you are. Assuming that you're a conservative investor, then even within equity, you will have more weight on the large cap and less on the small or mid cap. Similarly, if you're an aggressive investor, then more weight can be given to mid and small cap and less to the large cap. I do believe that this is not a very complex aspect to understand. However, working with someone can add value in terms of hand holding you and helping you grow your wealth so that you focus on your work and not just on this thing. However, I do feel that understanding the basics of these aspects is also important so that you ask the right question from your advisor, you challenge your advisor wherever the need be. That is why baseline understanding of things is required. However, if you're interested in this stuff and if this comes naturally to you, there is no harm in doing it yourself. It's not a rocket science at the end of the day. It is not about picking up stocks, which is more complex activity and more, I would say, full-time activity. Mutual fund investment would be more like basic asset allocation and reflecting on the portfolio at least every 6 months and ensuring that everything is in order. Now we move to how do we deal with the limitation of mutual fund. What is the limitation? The first is we can't use mutual funds tactically, which is we can't have a dynamic asset allocation looking at the market condition, what kind of combination of asset categories we can have. And secondly, we do not have exposure to the real estate. So how do we deal with this limitation? Well, first simple way of fixing this is there are exchange traded funds to manage this. So this is how I would deal with this. So in debt, we have Bharat Bond Exchange Traded Fund. In gold, we have gold ETFs. In case of a real estate, we can take exposure through real estate investment trust, which are listed now and you can buy as stocks. And we have equity ETFs, say Nifty 500 equity ETF is available from ICICI. I'm not promoting ICICI, this is just an example. So that can be taken to have that exposure. I have allocated say 40% to debt, 10% to gold ETF, 10% to REITs and 40% to equity ETF. This is just for a representation, obviously it varies, but this aspect can be dynamically managed. Again, it is not easy for a lot of investors to understand. I am still again repeating, stick to mutual funds in a very simple way and let it grow. Monthly investments or lump sum investments, that will take care of your wealth creation. But if you do not like volatility, this tactical management may pay off very well. So I run these strategies for the investors. Within that, I have this all-weather strategy. So when I look at the strategy, where I see that 1 year return is around 16.9%, whereas the benchmark, which is Nifty 50, this is a large cap index, is barely 10% now. And remember that a lot of crashes happened in the recent past. Despite of that, we are holding up this. And as I was referring to the volatility part, with the combination of these categories, what it tends to do is it just tends to reduce the volatility here. As you can see, the volatility is reduced, whereas you see with Nifty, there is a lot of volatility. And just remember one thing, that this is Nifty 50, which is top 50 companies in India. These are the least volatile, and still there is so much volatility. If I open up the charts for small and mid cap, they will be extremely volatile. So in order to reduce the volatility and tactically manage it, at times, combination of these 4 categories works really well. I have implemented this for many investors, and I have received very positive feedback from all the investors who do not like a lot of fluctuation in their portfolio. Just to summarize, asset allocation through mutual funds is a fairly simple task. Start with 50-50 or change basis your risk profile. And in case you want to tactically manage, then that can be done through ETFs. It may not be easy for everyone, so I would highly suggest be aware when you combine those. But to begin with, you can easily use mutual funds to make those allocations. I hope you like the video, and in case you want to know more about my all-weather strategy, you can write to me at this address and we will definitely reach back to you. Thank you.